Welcome to the Chaim Investment Advisor Podcast. I am Chaim, Victor Schramm, and I'm here with Pablo Lasha.
That's right. And I hear we have a really exciting topic to talk about today.
Oh yeah, we've got an episode that has been requested often, people have asked about often, and is really timely given the ranks of the undead are growing by the day on Wall Street. We're talking about zombie companies. And what is a zombie company?
I like the name. It sounds like I'm already interested in hearing more about zombie companies.
I know. Usually, I actually like zombies in movies. And so, I actually don't like zombie companies. believe it or not.
Real zombies aren't that good. Zombies in movies are much better.
Yeah, zombies in movies, you can turn it off when you get too creeped out, or at least the movie ends. And for some of these zombie companies, it seems like the liquidity never ends because policymakers don't want it to end. But we should begin with defining what a zombie company is. And you see a couple of different, occasionally highly politicized definitions. So we're going to go with like the minimum definition, basic definition of zombie company, which is a company that cannot survive without outside money in the long run, because it can service the debt that it has. It can pay the interest payments on the loans and the debt that has outstanding, but it cannot pay back the principal. It cannot give back the big enchilada. It cannot do that. It won't be able to do that, and everybody knows it. And so it needs to be on constant life support from banks, financial institution, occasionally governments, even through bailouts, to survive.
Yeah. Okay. First off, I'd say that doesn't sound good. If you came to me and you said I have a business and my business is able to service this debt, basically, like, I'm able to make my credit card payments and my mortgage payments every month, but I'm not able to pay more than the interest. I'm just paying the interest.
Yeah.
I would be like, that's not a good business. That sounds like a bad business.
Yeah, I can guarantee I won't pay you the principal, but I will pay the interest. I mean, it sounds like a bad deal because the person is probably going to be out there getting other loans to probably help pay the interest even, which is really, in reality, what zombie companies often do. They go out there, they get more and more debt, and let's say that you or I became a zombie company as an individual. In personal finance world, this really can't happen because credit limits are really exist. Your credit score, your FICO, that's going to collapse very fast. Very fast. That will come to an end, and you will go bankrupt.
Yeah, definitely. I think if I went to the bank and I was like, look, all these debts I currently have, I can't really, I'm never going to pay them off. Can I get some money from you? I don't think that they just laugh at me and be like, yeah, we're good, man. You know what I'm saying?
Yeah,
we're done here.
Pretty much. I mean, and so the whole reason these can continue to exist is that banks do exact an okay amount of interest. They know that they'll be able to get more money from other financial institutions and maybe even the government in the end. So they're willing to play along. The banks that give them the liquidity to continue hunting the landscape for more debt. They play a role.
Sounds like a bit of what is it? Is it like musical chairs, right? Where it's like,
yes.
You just don't want to be the bank that when the music stops that has the most money outstanding. As long as you can service some of their debt, and then someone else will service their debt, if you can be last in that section, you can make a lot of money. You get paid. Like, you probably you might have the senior ranking in the debt, so you might get paid first. And so it could be really good. On the other hand, if you just issued a bunch of new credit to them and now they owe you money, and suddenly they're like, yeah, the music has stopped. I don't know. That sounds really bad for the bank. So.
Well, yeah, and you hope that they happen to collapse at politically the right moment to have a policymaker say, "Oh no, there's so many firms that are doing this at once. We got to save them all," or to be called too big to fail. You kind of hope your counterparty, the zombie company who's borrowing your money, they get called too big to fail and they get propped up indefinitely.
So I'm curious. A lot of times, is this debt is this a special kind of debt? Is it securitized? Is it going to be debt that might end up in the hands of a larger investment institution or a consumer, a retail investor, or is it generally known that this situation is so bad that really only the banks should be in this business?
Well, yeah. When we're talking about publicly traded companies, some of them have a really crazy mix of kinds of debt. They will have preferred stock. That's a kind of stock that really functions as a debt and is not like going out and being a stock shareholder on the market. It has a higher status in terms of its standing if there is a bankrupt. You're ahead of the common stock people. So that you might have that. You might have regular bonds that we all know. Some of them, the first ones early on when this problem might be happening, might actually be regular, rated by Moody's, S&P. It might actually be a fairly normal bond. But then you get into places where bonds are not secured by anything, or they're secured by so little that they are not rated. So then they will start issuing bonds that are not rated at all. And that gets into pretty dicey territory very fast.
Do you think this is kind of an indicator then, if you're looking at the different types of debt that they have on their balance sheet, you might be able to tell if they're headed this direction, right? If it seems like this is a company that is going to turn into a zombie company, just based on the fact that they're not even any longer to maybe get publicly traded bonds, or now they're going to a specific single source lender, and these are indicators maybe that there's a problem. Is that what you're saying?
Yeah, because if you've got a company, it used to be investment grade, it used to be traded on liquid bond markets, and then it goes to junk, and they're still getting ratings. So most of the times when you make a bond issuance on the market for the public, you want it to be rated. You want somebody certifying that they looked at this and thought it was worth somebody's money to invest in.
Especially if there's no collateral, right? I mean, if there's collateral, it's the rating might matter less, because if you're you might be able to get something back from it. But if there's no collateral, it's really just issued on the integrity of that company's word, right? So.
Yeah, so if you're what's called junior, if you buy the junior unsecured debt, I mean, and it's not rated, and the company's last bonds weren't rated, I mean, you're getting into deeply speculative debt. This is a pretty excellent indicator that this is a zombie company, and many of the zombie companies out there do have junior unsecured debt that is not even really on regular bond markets. I won't name any companies. They're all pretty obscure. Most listeners probably are not going to actually know these companies. But I know many of them from the junior unsecured debt market. There's a huge overlap there.
Yeah, that makes sense. Okay. So what is the plan that these zombie companies have? Yeah. So if you're the CEO of zombie, what are you thinking? Where does this go? Where does this lead you?
You've got a couple of different conflicting things going on. You've got institutional inertia of, hey, we exist. Usually these companies have a history. Usually they were a good company at some point. Somebody, there just is kind of an inertia towards it continuing to exist. It sounds like it should exist. And so people just kick the can down the road as long as possible to keep that going. Then you have jobs like, if you're in a leadership role of a company in this position, you are thinking about the jobs of the people that work for you. Some of these companies, have tens or hundreds of thousands of people in their workforce. That matters quite a bit. And maybe you even have policymakers talking to you about that at that point. Um, if you're one of these companies, that's probably happening to an extent. And then every once in a while, there really are true believers in leadership who think that the big turnaround is just around the corner. Sometimes there's leadership willing to do something interesting enough to make that happen, and sometimes people are just running out the clock hoping for Hail Mary to happen at some point.
Hoping they're too big to fail, which by definition, everyone can't be too big to fail, right? So,
or that their competitors fail. It just miraculously outlives their competitors. They hope they die faster, which is very grim, grim reality for most zombie companies.
Yeah, I don't know if that's the strategy. That's like for me, that's like a sort of analogous to being on an island with other people, and there not being enough food and water for everyone. But just hoping the other people die out so you'll be able
to. Yeah. You're just kind of like hoping you're there at the end and maybe get a little bit bigger share of the remaining market share of whatever industry you're operating in. It's right now this is happening in the cinema space. You have Regal Cinemas not paying rent, even in Portland, Oregon, on their theaters. Kind of just hoping to not do that.
I have to say, it is very zombie of them, though, for that to be their strategy. Because I mean, what they're like with the cinemas, I only know of like two. There's probably more than two, right? But I know the two large ones, right? It's Regal and AMC. Is that right?
AMC, and there's also Cinemark, but AMC is the big dog, and it also is a zombie company that is failing right now.
Cinemark, AMC, all of these zombie companies is what you're saying.
Well, I actually haven't looked at the finances of Cinemark recently or kept up to date on them, but AMC and Regal, I know some. Yeah, not good stuff is coming out of these places. And so they're kind of hoping this is a good example, like, oh, maybe I will just hang out till the very end and be the last, cinema chain standing and the vaccine will happen and everybody's going to want to go, date night every night to the movies. And somehow it will survive and pay for all of the debt we took on to survive during this time.
Back in our hometown, I have to say Cinemark was my favorite theater. Not because it sounded like Cinnabon. I think it just had nicer theater seats when the last time I checked it. They were really, really comfortable. But,
it was cheaper. That's why I used to go there all the time. So yeah, I mean, that's the hope with the zombie companies, that you somehow survive long enough for things to change, and every once in a while you do get a company that tries to do something to mix it up to survive, but it happens less often than you'd think, because if you went to Wall Street Bank and asked your average guy who's involved in giving liquidity to these places, they will say, well, yeah, but we got to give them a chance to have their turnaround, and isn't that really what America's all about? And that is the party line of Wall Street on this topic. even though it's actually not all that often that they do anything interesting enough to make it likely that they will have a turnaround.
So, like, just out of curiosity, like, if you saw signs of this, right, as a shareholder, if you held enough shares, would you be able to, like, do something about it to make some changes in management or spin off all the assets and, like, get paid? Because it seems like at the end of the line, if you're a shareholder, you're not getting anything. Anyway, you'd be lucky if, like, the people in the junior tranches of them, right, would get something, right? So, so anyone who's past them is probably not getting paid anything, right? So it seems like it's a bad place to be. I mean, I probably would, like, not. Most of us probably can't own enough shares for it to matter, so I would just sell.
Yeah, I mean, if you're a big enough shareholder, it kind of depends, because you're not, as a shareholder at this point, if you're talking about big zombie company, you are no longer the only stakeholder who has the ear of management or the board. You actually will have politicians trying to jockey to make it look like they're doing the most to save jobs, because that's like part of their mythology on jobs, is how they interact with companies in these positions. So yeah, you're actually sadly, as a shareholder in a zombie company, your influence gets diluted more and more by people who are not actually directly impacted by it, which is a very unfortunate reality of being a shareholder in the long run of one of these companies. Is you become a lot less of a concern, because also the bondholders, they are the number one concern in a zombie situation. They are the ones who are going to hypothetically buy the new issue, to buy the new round of unsecured debt. They're going to buy the new unrated bonds. So they matter most. You are now the backseat in this situation. Yeah. And one of the problems in recent times is how fast companies are becoming zombie companies. Like I was just looking through the Bloomberg recent article on companies they have claimed as of this month are zombie companies now. You've got Boeing, Carnival, that's the cruise line, Delta Airlines, ExxonMobil, Macy's. These are not like small company. I mean, many people are shareholders of these companies that probably even haven't given a lot of thought to the fact that they are, because these are in a lot of your average mutual funds and even some exchange traded funds.
So do you think that, like, companies, like, without doing any, like, the in-depth analysis, companies like Boeing and Exxon, right? Do you think it's just some sort of temporary, like, because the conditions wander? Do you think that there's been too much pressure and it's like, we have come to a place where it's not recoverable really for them? They're going to have to find ways to steward these resources in a different manner.
Well, we're in this weird time where interest rates are so low, and so that's kind of like why zombie companies have become so prevalent. Is companies can afford to borrow infinite debt much better than they could have in the 90s or even 2000s, because even junk bonds, like I was recently looking at a very popular junk bond ETF's dividend yield, it was 3.5%. I mean, these are companies that might go bankrupt and are known to be a bankruptcy risk, and they are paying 3.5% on average. That's makes it possible for companies like this to survive, because even quality companies in 2005 we're not necessarily able to get debt that cheap. So I guess the good thing for some of these companies that are facing the reality that they were fine in many cases before COVID-19 happened, that they'll be able to kind of rebound because debt is so cheap and there is so much effort to just get free money in companies' hands to continue existing. So I think a lot of them, they're just waiting for COVID-19 to be over to see if they can turn things around. And a lot of them will. The companies that have recently become zombie companies, a lot of times I'm less worried about than the ones that were already zombies before COVID-19. That's a whole nother crop of companies.
And it does seem like there are some airlines that might have already not been doing so great. And, and now they're in a situation where they're really doing poorly. But, speaking of airlines, right, it's kind of a situation where, like, if you're in an industry that's getting lots of subsidies, right?
Yeah.
And then this might be like maybe the more, what you're talking about, like different politically charged terms. You're getting lots of subsidies, right?
Yeah.
It seems like it's sort of similar to being a zombie company, because if you need a subsidy from the government to continue to operate, right? I mean, then you're clearly you don't have margins to be operating on your own.
Oh, yeah. And that's another big overlap with the zombie category is companies who are taking subsidies on a regular basis, often getting handouts from the governments or bailouts. This is also not necessarily a strictly American problem. In fact, Japan in the 90s kind of pioneered the zombie company space pretty extensively. So you had a whole mix of government responses of various kinds, financial institutions constantly intervening, constantly being helped to intervene. And right now, this is actually happening in China pretty severely. China, as we speak, is grappling with a lot of difficult times from zombie companies, and also in all different sectors than America faces. They have, the ghost city phenomenon. There's no way that there's almost no way that the ghost cities do not become zombies.
It's
crossover there.
Because, this was back 4 or 5 years ago, and even even before that, I used to hear a lot of rhetoric about China. They have 6-7% growth, and so I was curious. I spoke to people I know. I just asked them about it. What do you think? And I did some research, and then one of the first things I found out was about those ghost cities. I was like, so it's easy to have 7% growth if you build a bunch of stuff, but that stuff is not then turned around and used by anyone. It's not really growth. You just paved all your roads and it was the same difference except the way they're useful in the public.
Yeah, and I had heard, somebody had sent me an article which was really just an opinion piece that that there's no ghost cities in China. And then I was in China a couple of years ago and saw it myself. Just you can't drive around a major city suburb in China without encountering one or two of those, where it's blocks and blocks of skyscrapers with absolutely no cars, no people, no residents or anything. It's very creepy. It's very strange.
One of the things I think that sometimes when people, they operate from a top-down perspective, forget is that people need to organize amongst themselves for things to actually work. So you can build all the skyscrapers and all the storefronts. You can even build your own. It's the same here if you build your own privately planned community. But unless you give people the space to operate in that privately planned community the way they want to, no one's going to inhabit it. If I build Pablo's community, and then I just say I have all these rules, and everyone's I don't like your rules, Pablo. No one's coming.
Well, you're going to be borrowing from the banks until somebody rents your apartments in your community.
Let's not be giving away Pablo's company's game plan now, right? So
yeah, and so they, China grapples with it. America does. Europe has also encountered some pretty severe intervals of growth of zombie companies. So this is many different economic systems out there are dealing with this at the same time in different ways. And we should talk a little bit about what are the effects on the greater economy, but also like as a shareholder, what does this mean? Why should any of us care about it? I tend to think the big consequence to this behavior, policymakers who are supportive of zombie companies will always say, well, we got to prop them up. They create jobs. And, one economic problem I have with that is what kind of jobs are these? Like if you're earlier in your career, you work at a company that's known to be one of these companies. What is your career trajectory? Are you excited to, climb the corporate ladder in a company that has no future, that is pretty much known to not have a future? That is not a thrilling job prospect to me personally.
Yeah, no, I agree. I mean, imagine back in the day, you like work for some sort of telegram company, and the phones come out, and you're specializing in telegram technology. It's not to say that like there's not a niche industry for everyone, but that niche by definition is very small. So you do not want to be competing with many other people for that space. That really makes sense to me. So.
Yeah, so that there's that. Also, like if you somehow then become a leader of the company, you're not probably wanting to become a high up established leader of a company that is going to go bankrupt, right? Because that does not look good on your resume. No matter where you figure you're going to end up later, it's not going to help. So leadership becomes intrinsically toxic to careers of people who are paying attention, and that's a big problem.
So I'm curious then, do all companies now that are going to like eventually go out of business or file for bankruptcy or reorganize their resources, do all of them end up becoming zombie companies? Is there a graceful way for a company to realize it's over? Is that less common now though, since there's a huge job mandate on politicians and everyone else feels like, hey, we have to make sure that people are working? Has that changed recently, and is that why there's more zombie companies?
Yeah, it's interesting in the unlisted companies that never go public, where there's just an owner or a family ownership structure. Much more common to recognize the reality of the situation, and I've worked with people who have run companies where they say, "Hey, I'm not in debt, I'm not bankrupt, but this is going nowhere." It's much easier to recognize that and walk away from it, and wind down the assets of the company in a way that makes it kind of worth your while to call it quits and help you do something else. When you've got very large or even middle-sized, publicly traded companies, that becomes an entirely different thing, because you have so many conflicting stakeholders and you're operating often in so many different communities that it becomes very difficult to be the one to say, yeah, this is we may as well just like acknowledge this is over.
Like it seems in my experience that like if you are a shareholder and your company is like either not turning a profit or just barely surviving, keeping its head above water, the best scenario is that you merge or get bought out by another company, because that is the only scenario I've ever seen where there was some equity still retained when the transition was over. If that doesn't happen, usually it seems like you either get nothing or very close to nothing.
Yeah.
And everyone who owns debt is who gets something, and hopefully, if they're lucky, they all get paid out. And so, like you said, like maybe it's very different for companies. Like it seems like there's a much more lax attitude in the public sphere to be like, if you're to like sort of let the shareholders not get what may be the best for the shareholders, right? We're going to continue to go on, and now, obviously a share price is not always correlated with the actual value of the company. And sometimes the markets are very late to realize that this company is not worth anything.
Yeah, absolutely. And people, will try to bargain hunt, and then they become very invested in it, somehow turning it around. And so you get a real mixed bag of different shareholder interests. You get hedge funds coming in and trying to bully leadership to do this or that to make it work, and some of these end up being very public. Yeah, you get the activist investors. They love to get involved in certain situations like this. And then you get the people who are, very public about shorting the companies. That's another thing that happens. I mean, it becomes a total circus. The longer it goes.
And isn't it true? Sometimes you buy a private equity that comes after you, try to buy you out, and then basically sell off all your assets. They have no intention of keeping you on any jobs. So you really have a lot of sharks in the water around you for a zombie. You know what I'm saying?
Yeah.
A lot of things trying to eat you.
Yeah, absolutely. So it actually is not an enviable position to be in for anybody involved. Not really great for shareholders. Definitely not great to be a leader, and not really great to work there either. Because job insecurity is pretty high on a persistent basis. So that's that. Some consequences. Yeah.
So in your opinion, is there a good reason that someone would want a zombie code in their portfolio?
Ooh, that's a good question. I mean, I would tend to think if it would have to be a situation where an investor has a pretty strong read on an industry and a company's position in that industry. A current one could be like, hey, I think right now there are a ton of hotel companies that have become zombies. Braemar Holdings, a prominent example. It's probably not going to survive. And there's a bunch of other ones in the same position. And if you knew that industry well enough, and you're willing to bet that, hey, this particular one is probably for X, Y, and Z reason going to be the holdout and be able to maybe buy up some of these other locations at a discount, and maybe get the kind of liquidity to do that from, people who want to facilitate that. That could be, one reason that you'd want to do it. But this is distinct from what you'd call deep value investing or value investing, where you're looking for cheap stocks. In fact, most of these companies, through the value investing, is trying to buy assets or cash flow at a discount. Most of these are actually extremely expensive through the lens of the the amount of money that you are paying for what is really happening at the company. Extraordinarily expensive in some cases. So this is a very different space from traditional value investing in general.
So no is the
answer. No is my answer. I'm not a real advocate for zombie company purchasing, mostly because I do tend to think that the things that I look for as an investor are not happening at zombie companies. CapEx, a capital expenditure. That's a business investing in itself in creating new markets, new opportunities, is never really existent at zombie companies because they are not taking new debt to do CapEx. They're taking new debt to help with the old debt. And so, yeah.
The only time I could see a business, that didn't have any capex being a worthwhile investment is if they had a monopoly on some sort of natural resource. And it's the only time I'd be like, oh yes, if you're the only person who owns water in this country, I think you're going to do all right.
Yeah, there's very few zombie companies that truly are in that position. So I can't really see why you'd want to have them, and I can think of so many reasons to not have them because they do not really have real growth. Some of them pay dividends, but those dividends start to get paid out of not places that you want them to get paid out of. Usually you want dividends to get paid out of free cash flow and profit. So that's a company is actually, generating new money and profit margin, and then giving you some of that. That's the optimal dividend investment. If a company is selling off assets or shutting down operations to make sure you get paid your dividend, it's not worth hanging around for more dividends, in my opinion, ever.
That makes sense.
Yeah, because you don't have growing dividends, you probably aren't going to again at that point, and that does happen. That's something that has happened in Europe many times with even publicly traded companies in Europe. They end up paying out, 110% of their profit in dividends. A dividend payout ratio is a number you can use to see, hey, is my dividend stock maybe a zombie company? Sometimes they are.
So in this musical chairs of death, when the music stops, right, someone's going to lose out, right? Someone is obviously stuck with, well, first of all, the shareholder are probably definitely losing out. It's likely that most or all the values can be wiped out. And then those people who have the junior debt will be lucky if they get anything back, because the senior debt's going to be ahead of them. So here's my question is there some sort of move now towards some accountability by banks and institutions? Or because for shareholders, that can encompass a lot of different people. That could be retail investors, that could be institutions that pension funds come from, and things of that nature. So I see a large exposure to the public, and also to people who would not have done this had they known, what exactly they were investing in. Right? They would not knowingly been yes, that's a good investment. I think common sense kind of tells us that. And then the second question is for these people who might have that less liquid or maybe non-public debt, usually they have to be a particular type of investor, right? So on that side, you're not really getting exposed. So maybe it's just most of the shareholder, or there's someone who's kind of getting exposed to this, who's those interests aren't really taken into account. Is there some move, do you think, policy-wise to curtail that, or is that just kind of the way the cookie crumbles now?
That's one area that I have no idea what the policy solution to something like that is. I tend to think, financial institutions should maybe refuse in some instances to play the role that policymakers want them to. I definitely think that's the case because sometimes financial institutions are not making decisions in isolation or in pure thinking about profit. They're also thinking about other aspects of what they could get out of it or what's expected of them. And just refusing to do that kind of business is good. I think bringing firms that are investment banks that are helping to bring some of the debt to the public markets that they could be more responsible for sure.
So maybe then,
yeah.
since there doesn't seem to be some sort of policy answer, and there doesn't really seem to be a lot of political will, I guess then you really need an investment advisor to to help you from in investing in things. You do need some sort of like professional advice that says, hey, this is a zombie corporation. And I think, to me, what I really think about right now is like, a lot of people have 401ks or 403bs,
Yeah.
and obviously, like, there's regulation in 401ks and 403bs and like how those portfolios are created, but it's not the most intense scrutiny ever. I've seen some of them, and it's not always like, to the standard that I'd be comfortable with if I was like just recommending something to a friend, And so it seems like these are the places where someone would really like to park a lot of this zombie corporation equity, because it's a great place where no one's going to complain too much or look too much into it. Oftentimes we see that like large institutional investors don't want to step outside of a certain bound because they don't want to be the one who made a different decision than everyone else.
Yeah, absolutely. I mean, this is one area where I think quality investing matters. So this term quality, and I know it's come up in other podcasts we've done, and I definitely recommend quality stocks pretty often. So some of the people listening right now may have quality stocks in their portfolio because I told them to. And I think this is one area where that matters, and leaning into quality is better, because this word quality just means fiscal health. It means using quantitative means, that is numbers based means of finding out, not a qualitative where you're looking at a narrative of how this company could be good, or a description of it. You just want to know, can they pay their debts or not? Can they actually meet their obligations, and for how long, um, as things are right now, in favoring quality over non-quality? Because in the end, a lot of these companies that are zombies, that are in mutual funds, that are in 401ks and 403bs, if somebody's using an index fund, they might be in the index, but hopefully indexes respond to the reality that these companies, they are not something you want to have be very weighty in an index. And some indexes are more responsive to that than others. If you just use vanilla cap-weighted index, sometimes there's not much you can do depending on the index.
If your index, is factor oriented, and quality is one of its purposes or one of its goals, then you can hopefully you'll see like that it doesn't hold any of these types of companies, right? So,
yeah, and you generally don't see. Well, you never see zombie companies showing up in quality portfolios, because they're pretty aggressively screened for the kinds of early warning signs that happen with a zombie company, where there is really not good free cash flow, where there's really not good accruals ratios, where there's very early signs of like, they're trying to make this look a lot better than it is. It shows up early, so they don't tend to show up there. But yeah, and then if you've got an active portfolio, I'm not a big advocate of using active portfolios. There are investment advisors out there who would say, "Oh, this is the reason you want an actively managed fund." We've been looking for a reason to get you into one of those, and here it is. That's not actually something that I relate to. I don't see a lot of evidence that active managers actually are dodging these bullets any better than indexes are, frankly. Because a lot of times, active managers are tempted by, falling share prices. And they don't think about, they are interested in, hey, well, if it turns around, that'll be great for us. And some of the time, these companies are not going to turn around. They are going to face a very slow, sometimes decades-long demise.
So this has been a really uplifting conversation.
I mean, I find it kind of amusing, but
Yeah. No, I think that like, when you first were talking about like, let's do a podcast and this, like, I thought it was really interesting. One, just from like an investment point of view, but two, just from like a sort of world, sort of macroeconomic point of view.
Yeah.
There's been this like growing subset of companies which, by definition, are not profitable. And
Yeah.
Just so everyone knows, companies are meant to be profitable. Like some things, government doesn't have to be profitable. Non-profit organizations, I think they have different orientations, different goals. But companies, profit is like, it may not be the number one thing, but it's the number two thing after whatever the number one mission is. So not being profitable is generally not a good thing. And so I just thought that was really, really interesting. That it's become more and more prevalent. And it's something both from like on an individual level, from your portfolio to think about, and then there's something just to think about on sort of a broader level. I mean, imagine you live in one of these regions that's populated by one or two zombie companies, right? And you know this, right? I mean, it's a good indicator of like, should I stay in this? Like, just in terms of financial planning, it's like, is this a good community to stay in? Will this community be around in 10 years when these two companies collapse?
Yeah.
And so there's just a lot of implications. I think it's a really interesting subject.
Well, yeah, and I tend to think that there really are more perspectives, more political perspectives that should be skeptical of zombie companies than you always find. Like sometimes people really find the jobs and the labor argument very persuasive, but from a progressive perspective, zombie companies are not making a great impact on our society. They are generally making a pretty bad one. They are definitely taking up a lot of resources, a lot. There are almost $2 trillion of outstanding debt from Wall Street zombie corporations. That is not progress.
Totally.
That's not what I tend to think of as progressive at all. And it's also, if you maybe lean more right, you're more of a free market person. Well, is that really a free market? Basically policy makers leaning on financial institutions to prop up failing firms and taking up resources that could go elsewhere to more innovative, newer, interesting, high impact dynamic companies. These are perspectives that I think shouldn't be too controversial.
I think you're right. I think like from both sides, you have a crowding out effect in terms of investment. So all that money, all that public debt could go to someone else. Could go to a young, innovative company that might service communities not usually serviced, or service people who don't get a particular product or service or some sort of new innovation. And then on the other side, as you mentioned, oftentimes, especially if the company's large, or especially if the company's in a troubled industry, their hope is that the government will come bail them out. And I, for one, have seen enough of companies getting bailed out of anything. Really, like, people, bailing out people is one thing. Bailing out companies is it just makes zero sense to me. I don't really understand that. So, I think that like you said, I think that like part of the problem probably though is that it's uncomfortable in the sense that it requires people to be accountable. Like you said, we have these institutions which are, helping to secure debt. Even in the end days, when it goes to like, a certain quality of investor, or it goes to a syndicate, or it goes to just a particular institution, it's still that someone's money, right?
Yes.
They're helping to service someone's money to a company that knows cannot service that debt, right? And then you have the people who are maybe at the head of the zombie corporations, and they don't want to tell everyone, look, it's not going to work. You need to find a new job. There's no good time to find a new job. I've been in the job market for a long time now, not like looking for a job, but just like, as a working adult.
Yeah.
and I've never, whether we're in a boom or bust, whether we're in like the worst time or the best time, there's never a time where I've been like, yeah, now's the time. Let's just like find a way to transition my life to something completely new and different. So it's not easy in that sense either. And so I think it's like you said, just like, it's very difficult for people to sort of take this head on as a country. That's the reason that Japan had this issue. Is the reason that like European countries, it's not like an American issue specifically. But I do think it's a serious issue in the sense of, one, in people's investment portfolios, and two, just as a country in general, because you don't want to have so many zombie companies one day that you really can't let everyone fail. That's like way too much to take on for anybody. So, yeah.
Well, yeah, that's definitely like, in the late 1980s, what happened in the USSR. That's really what brought the USSR down, was that reality that there were so many failing going concerns of the state that nobody, or early on, people held those things accountable. Nobody wanted people to be doing wasteful work that didn't improve society. There's supposed to be, that's supposed to be the whole thing. And then for people to be doing, meaningless work just to, look like they were doing something, made everybody mad originally. And then at some point it started to become the norm and nobody could talk about it. And before people knew it, it was over. I'm not saying America's or China or any other country is actually going that direction, but just to say it is not a unique American problem, but it is something that hopefully we're uniquely equipped to actually deal with on the positive side.
Yeah, and you just mentioned tail risk. I think tail risk is important because it's there for a reason. I think that people forget, like, they say, like other people say, it's a 1 in 100 chance that's going to happen. And I'm like, but if you know anything about statistics, and you do something 100 times, what do you think the chance that it's not going to happen once? You know what I'm saying?
Absolutely.
It's probably a lot larger than you think. So, I think that like that's a good way to explain zombie companies. I think that people probably have a lot better understanding. Hopefully, you're not just sitting there depressed now. Just like
I know.
This podcast. I was thinking, like Chaim and I have talked about other podcasts we're going to do, and we are going to do a quality factor podcast and follow up on some ESG podcasting, maybe even combine those into one. So we're going to be talking about some positive things in the future. But this is a topic that seems relevant right now with a lot of companies who have, like you said, recently become zombie companies. Hopefully, that's it's just a temporary phenomenon.
And it's worth mentioning super low overlap with ESG. Zombie companies are not, generally speaking, showing up in ESG portfolios because they aren't great at social impact. They usually are bad at environmental impact because they are doing whatever they can to cut costs, cut corners, and stay alive. So no, they are not environmental leaders. You know what I mean? Like almost never is that the case. And the governance usually is quite bad because good people who would be good governors of companies leave. They see the writing on the wall. They're not there. So these are not ESG leaders ever. And so, when we're talking about ESG, which we should talk about much more, that we're talking about a space that doesn't really include zombies. This is more the what you call low quality investing. We had a blog post about that. Continues to be one of the most popular articles I have ever written. The rise of low quality investing on the website ChaimInvestmentAdvisors.com.
And I'm excited to do more ESG podcasts because we want to talk about really what we talked about in the ESG podcast, which is people bringing their values also to their investing because it's important. Yes. In terms of like just being comfortable with your investments. And this is a great example right here. Maybe you're out there and you say, well, look, Pablo, my values say I want to support the zombie company. Well, there's probably a best way to do that if there is a way to do that. I don't think anyone would really say that because we've just gone over all the reasons why it's a terrible idea, even from a social standpoint. So yeah, like I think that it just highlights the dangers, and it highlights like how we're living in a changing world of expectations, and so we do have these companies, like you say, that don't really rank really high on any factor, any standard for ESG that are out there, and we have a lot of great companies that are there to invest in. A lot of companies which have a positive cash flow and they're doing good things for the world or the environment, and they fit these values.
Yeah. Well, yeah. So this is a good place to end the zombie corporation conversation, and look forward to a much less creepy. Although we do love the creepy topics. We'll be honest. I'll be honest. It's probably my influence, right?
There's something interesting in every topic, I think. And actually, we have a couple of podcasts on our list, and we've kind of made an agreement about how many podcasts we're going to do a week. So we're probably going to step it up. But we have a couple of podcasts, and one of them is Trader Movies. So we do have some lighthearted topics coming.
Oh man,
movies with traders. I think I don't know. I just love that topic. I also love just it's cool when you watch something that has to do with a world that you understand or been exposed to, and you're trying to think of how realistic this particular thing is. Or are these people just throwing out random words that make zero sense?
Yeah, there's got to be the next one to offset the towerness of you got to have a comedy after you watch the horror movies.
Exactly.
Yeah, we'll do that. Cool. Well, yeah, this has been the Chaim Investment Advisors Podcast. I'm Chaim, Victor Schramm.
Yep, and I'm Pablo Chaim, and thanks for listening to us.
Talk to you next time.